Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good evening to those on the East Coast. We'll let some few people join. Hey, look at there. We got a mucker listening in as he grinds through his evening work. Today is the Weekly Notebook Review. It is Wednesday, July 26th, the last Weekly Notebook Review for the month of July. It's been a great week so far. A lot of things to talk about tonight. We haven't had one of these in 2 weeks just because of some travel that was happening last week, some big kind of Hedgeye strategic meetings, the mid-year company meeting, and some other type of events like our summer party on Friday. Like many of you saw, Keith and Jonesy Buds, I was on that winning team. Had one bad round, but got it back together, and we ended up winning. I think it was 4-1. So that was a lot of fun at the Hedgeye company party. The families were able to bring our families. My wife and kids came down from Massachusetts, and they had a blast. Slip and slide, kind of like one of those blow up water slide thingies. It was a great time by all. But that's not what we're here for tonight. Tonight it is Weekly Notebook Review. So again, now for anybody who is new to this, who's new here tonight, this is kind of reviewing your weekend work midweek, seeing how the market has shifted. Assessing how to kind of prepare the portfolio once signals jumping off the screen, going into the back half of the week, next week, next month, as the month of August is around the corner, next quarter, et cetera, et cetera. So, to kind of steal a bit of a macro show concept in a top three things format, my top three things tonight is going to be volatility, the dollar, and then emerging markets ex China. So those are kind of the big three topics that I'm going to kind of review here. And then obviously anybody listening in, this is an open forum for Hedgeye Nation. It's we're here to get better. A lot of power users over the years have just kind of hashed it out, right? Talk through kind of things that they're seeing on the screen. So this format definitely works really well in terms of just being able to have dialogue back and forth. But to dive into the top three things, volatility, VIX went basically down to the low end of the risk range from today's risk range. And that's an interesting component, right? So you could kind of mean revert or have it kind of go back from a probabilistic standpoint to the top end of the risk range, which for all intents and purposes is basically 13 to 16 at this point in time. What it does from there, I think, is the big question. And that's what I would kind of recommend everybody be paying attention to, is sort of, how does it function? How does it act as it goes, as it potentially goes to the top end of the risk range? Does it hold up there and kind of, potentially move higher, which could be a signal, one of many that you'd be watching from a price volume volatility standpoint, in regards to, could we see a move out of the, quote investable bucket, which is below 19. I think it's going to be really interesting in terms of what, vol sellers do. Or kind of, long, folks that have been long vol since 19 and it really hasn't worked for the last few months. What do they do? Do they take some profits and do you get a quick bounce and then it basically, moves higher from there? So again, that's a big piece, but you saw, not only the VIX, but the VIXM and the RBX. So that's the Nasdaq volatility as well as the Russell vol in terms of, U.S. equity volatility kind of all moved lower today. I'll pin a tweet from Tier 1 Alpha, but they just tweeted out that there's, I believe, 12 billion in sort of, vol action that could basically happen into month end here over the next day or two. So something to be paying attention to, and could be one reason where you're seeing kind of vol suppress and move down to the top, to the low end of the risk range. But going beyond just U.S. equity vol, the other big move that caught my eye today, and it's something that I certainly was keenly paying attention to, and Keith mentioned it on the macro show today, but is that move index, right? So the move is U.S. bond volatility in terms of yields. It was down a little over 7% today, back down to round number of about 105. So that trend level, he gave it to me in the macro show. You got to do some due diligence on your side. I'm not going to share that right here tonight. But I think if you go and deliberately study that macro show from today, you'll know exactly what that number is. And we broke down below it, so it's currently bearish trend, which again could be positive for bonds and kind of yields, and especially the longer end of the curve. That curve remains inverted at minus spot 987 between the 10s and 2s. So yeah, what does that mean? So again, FOMC is now is behind us. It certainly appears, and we're of the opinion that that Powell is going to most likely have to hike again, especially with July inflation, the way it's kind of gone about so far, right? So if you kind of look at commodities and how we've adjusted our portfolio from an inflationary standpoint and kind of call it a quad 3 in July type environment, that's sort of what we're seeing, right? The USO oil certainly has picked up steam in regards to remaining bullish trade and trend, and that's been that way for I believe about 3 weeks. So again, it's these inflation environments are going to be a problem for Powell, and therefore could it be that this move is a bit of a head fake? I'm not sure, but certainly time and space is going to allow it. We're playing the kind of longer end of the curve through BNDD, and we're very happy with that. We don't always have to be in every market, but certainly from a volatility standpoint, just wanted to call it out tonight on the notebook review. So the point number 2 was the dollar, and that has basically remained bearish trend at this point, right? And kind of has lost a bit of its footing. We're completely out of the dollar. We sold our position in UP, I believe that was last week. So again, just wanted to call that out here on notebook review where I didn't host one last week. So again, that dollar and the inverse correlations there on the dollar are something to be really paying attention to. So this morning, the gold, inverse correlation remains, I believe, around negative 0.9. I think it was 0.87. Let me just double check my notes here. Sorry. 0.85. So gold remains inverse correlated to the dollar on a 15-day basis. S&P and Brent oil, BC would be the futures contract on that. Those have kind of decreased their sort of correlations to the dollar. So we're down at negative 0.67 on the S&P on a 15-day basis, and minus 0.50 on Brent, and on the CRB index, we're actually down at negative 0.46. So those aren't as correlated as they had been over the last week or two. But on 30-day basis, they certainly are. Those are all basically above minus 0.7, so still very highly correlated, inversely correlated at this point in time to the US dollar. So something to be paying attention to, and certainly something that is potentially impacting not only, again, it's kind of a good segue into EM. So EM certainly does well when the dollar is weakening or sort of bearish trend, and that's and we're not only seeing that and getting exposure along of things like EMXC from an ETF standpoint, India, South Korea, Japan. We covered Australia short a week or so ago. Those have all been great decisions and really fantastic asset allocations to have in the portfolio. And not only as a signal backing it up, but you're also seeing our nowcast, our GIT model, our GIP model, growth, inflation, and policy, back that up as well. So you're seeing a number of quad 1s and quad 2s across the board over the next few quarters in countries like Vietnam, Philippines, Japan, South Korea, et cetera, et cetera. So again, that EMXC is a great way of expressing that. It actually made new 1 month and 3 month highs today on closing prices. So that's been, that's exactly what you want to see. You want to see, you want to have things in your portfolio that are bullish trend and trend, making higher highs and higher lows, and making new 1 month and 3 month highs. So with that, that's the top 3 things today. To steal a little bit of a macro show, something we talked about last week. People really do well with 3 things. So in the past, I've kind of run through the gamut of the global macro, but just wanted to narrow it down to some of the best, to me, some of the bigger call outs and things that we should be paying attention to. And if you don't have them in the portfolio, you should really be considering kind of adding to those or navigating these things or thinking about these things as we move forward here in the next week or two. So if, we can open it up. That was kind of a 10-minute segment. If anybody's got any questions, I see a lot of friendly faces out there. Trillion Cap from Canada. Welcome, my friend. I'll be visiting my parents up on Simcoe in a few weeks. Should be a lot of fun. I always love getting up to Canada. We can certainly keep running through the gamut, though, if nobody wants to jump up. All right. Well, I'll just keep going through some Hedgeye things that are happening. So kind of key call-outs today. Keith went from snoozing on the Red Eye Green Eye app. Again, that app is free if you haven't downloaded it. It's an absolute gem. And so went from snoozing bear, the Thunder Bay Bear, to a sell, right? So he was a seller kind of post the FOMC, post Powell, during Powell's presser, I believe is when that came out. So again, that was something that's new today. The other component is we were certainly adding some shorts within RTA, but being still very selective, right? I think he made a comment that he basically moved from about plus 1% long to kind of about minus 1.5. So I'm not sure where he ended up, in the at the end of the day in terms of net short, but certainly was kind of building back up his, Keith was building back up his short position. But this afternoon we added, things like U-Haul, Sally Beauty, Dada, which is a Chinese company, and I was actually pitched, I believe, by Felix Wang today on the pitch as a short. So that was, if you haven't seen that, those were 6 analysts, six of our sector heads giving out 6 stock picks and ideas with Keith to kind of run it through the gamut, and about over 60 minutes. So basically each one had about 10 minutes to review. I actually had some meetings today, so I wasn't able to catch all of it. But again, that data I know was Felix Wang's pitch today. So certainly, yesterday was I think a really important call out in regards to Chinese real estate. So that was something where he and Rooster had been kind of talking about that last few days. But again, if you don't wish to short Chinese real estate or that kind of thing, then go look at some areas within China that you might want to short, right? So whether that be KWeb or something like that. Again, we're not short of the KWeb. We're short more of FXI and EWH. But again, it doesn't mean that you can't make your own decisions in terms of your portfolio. Keith, welcome to the Wednesday Notebook Review.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40-plus equity analysts discuss key market developments, trends, and our high-conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
He's a speaker, but he might be on mute.
Can you hear me okay?
Now I can. Yeah.
Oh, great. Well, thank you. I was, I guess other people are probably busy with life, and I do have a couple things that I wanted to review that, my workflow restarts at about 7:30 at night, right? So as soon as we get Bloomberg's options data resets, and I get all my flow data now from both Tier 1 Alpha and from our own team, obviously, I get a whole bunch of other things to do, and I obviously know right now what my risk ranges are going to be tomorrow morning on the U.S. equity market and all that. So it's an amazing setup. I mean, not only did we add China real estate on the bounce, but secretly I added China Financials. The ticker is CHIX. How about this one? CHIX. Like not checks, CHIX. CHIX. So that was at the top end of the range. You never know what's going to appear, right? Like yesterday it was Israel at the low end of the range, and voila, we got paid nicely there. Immediately, this isn't about day trading. This is about asset allocation, right? So, and running a good long short, but it was really the first day. It's the first day that I went to net short. That's why the red eye came back on. So for those of you who don't know how to use that, I think a lot of people overthink it, but it's pretty simple. It's like when the red eye goes on, I'm not shorting spies. It just means I'm selling shit, right? I'm selling my longs and I'm selling shorts. So when the red eye went on, to your point, I shorted Dada, which again, Felix pitched. So you'll notice there's a bit of a pattern there is that I'm reloading on China. I have chicks. I don't have the Chick-fil-A. I have the chicks. I have the China real estate. I have the Dada. And Felix explained that. I went right to the wood on some of the fur. So, U.S. retailer, Sally Beauty. And I went to the real estate with the U-Haul. So very consistent, with the process. Again, I think the most important thing is always let's have a process, and also let's just be patient with it. But the main thing I want to call out that in my risk ranges tonight, and this is kind of I think this is the open question. On the macro show, I don't have time to really do anything other than project my views, right? Like you're presenting, I have to sing a song for 15 minutes, and then I have to entertain in some cases, consensus questions, and that's kind of it. But, after the close, between now and when I go to bed, 9:30 at night and 4:30 in the morning, and I get to sleep those 6.5 hours, God willing, 6.5 to 7 hours, this is what I'm really thinking about is what is the early look going to be about tomorrow? Mm-hmm. And so I have notes, right? My notebook has notes. And I think the question is, was that it? Was that it? After all the bullshit, after all these storytelling about AI, was that it? That's the question. I mean, that's really it. If I just look at the risk ranges and I look at AI, I have lower highs in NVIDIA, lower highs in Microsoft, I have lower highs in Tesla. Tesla, I hate to remind people, but, a lot of people came into earnings season long Tesla, Microsoft, and got their ass handed to them, right? It's a lot of people were long these stocks. Now, it's kind of bullshit. If you really listen to these companies, I mean, Microsoft said it's 150 million in revenue maybe, and they're kind of slapping a lot of bullshit together. 150 million. We're talking trillions of market cap, okay? And then Meta today, which we're long, and this is going to be really, I'm going to ask Friedman, is that it? We've been long Meta. It's been fantastic. Friedman has had a hell of a run. I stayed away from Snapchat. It went down another 18%. He's long Meta. He's long Google. It's and now Zuckerberg can't help himself. He's the whole bull case for us was that they were cutting costs and they were going to have some discipline. But lo and behold, the only catalyst that got the stock going in the aftermarket was AI. We're going to do some stuff with AI. We're going to tell you in September about it. And we're going to start spending again. So when Microsoft said it, they said that we're going to have to spend billions to get hundreds of millions in revenue. And this sounds very familiar. It sounds like the metaverse. So, we've gone through a lot of bullshit in my career, dot bomb, blockchain, Michael Saylor, SPAC Jesus. Now it's AI. And I wonder, was that it? That's it. The Nasdaq's still down 12% from where we went bearish on it. We're not short it, but we understand how to risk manage it. We're not idiots. The Russell's down 20%. Was that it? What is the bull catalyst here? Really? If AI was just, a classic Wall Street pump and dump, was that it? That's what I want to know. I think I'm the only bear left. In terms of what our clients tell me, big institutional clients, they'll be okay, Steph Pomboy's bearish, David Rosenberg's always bearish, and there's you, who's bullish and bearish, but we lost Mike Wilson to the bubonic plague or something like that. There's still was that it? Is that really the way this ends? In an echo chamber of vol trading? I'm really wondering. And I know a lot of people have a lot of feelings and thoughts about that, but I'm going to write about that tomorrow because that's what's in my notebook.
Yeah, it's a great call, and certainly Tesla is something that on a week-over-week basis, I think has a completely different picture, right? And especially from what the data from the risk range is telling you. I mean, last week on the 20th, Tesla risk range was 255 to 296. This morning it was 249 to 290. So a big lower high, kind of on a week-over-week basis, but more importantly, a massive lower low, right? Moving from that 255 to 249 number. So, again, like that, and what I tell a lot of people here, Keith, is like, and you coach it, brilliantly as well, obviously, is that top of the risk range, it's no longer, the probabilistic today at 290, it basically can't get back over its peak going into earnings, which happened last week, right? So it's like it's stuck there, because that high from a week ago was 293.34. So 290 is the probabilistic component today, and given how it moved today, I can't, that top of the risk range, it's possible that it comes even a bit lower tomorrow. So the kind of to front run your signal in terms of like, is that it? If these things can't recapture, their recent highs, then that is it.
That's the whole point of the process, right? I mean, especially with Tesla, because of course, we're not monkeys, so we're full cycle investors. We don't sit here and belabor and bemoan like what you could have been long if you were just long it. You're only long from the lows, but you're never long it on the way down. Like, I love that one, right? That's a great old wall thing to do. Like, you're like, you weren't long the NASDAQ from the top, but you went to an 80% asset allocation on December the 28th, and you're a fucking brilliant genius investor. And it's like the things people say, right? But if you actually pull back the curtain on when we went from bullish on Tesla to bearish, or bullish on Bitcoin to bearish, this goes back to November of 2021 when Tesla, of course, is around $400. Now it's at 264. 264. Mm-hmm. 264 is not 400. It's not 300. It's not 275. And what's interesting about this, in addition to what you just said, is that there's an implied volatility discount, like in the teens. So you're saying there's a chance. And here it is, like, was that it? Really, was that it is a question that has to do with behavior. So when we think about the mother of all bubbles, #Moab, you have to think about what perpetuates a bubble. Well, a bubble is a bubble because it keeps going up. But a bubble pops when that behavior is no longer paid out. And for 2 weeks in a row, the Tesla weekly call options didn't pay out. For one day in a row, Apple's call options weeklies didn't pay out. You're starting to see today there was more puts than calls on even ODTE SPY options. And we got through a major event, which is, of course, the Federal Reserve, just doing what they're going to do without any kind of like surprise factor. But there was a lot of hedging around that event, which we really highlighted with the tier one options data, which has kept the market kind of pinned in a range. But was that it? Like, typically, when I look at lower highs in my career, whether it be 2000 and 2001, 2002, 2008, and again, it's not like we weren't on the right side of the bull market in 2009 and the right side of the bull market in 2003. So for all those out there that have all this experience, which is T-minus 3 years, I salute you. And I welcome you. But this isn't my first rodeo. Lower highs are lower highs, and slowing economic data is slowing economic data. What's different this time is that the Federal Reserve is actually continuing to tighten into it, which is an amazing thing to watch the narrative drift. Because I'm old enough to remember, when people understand why banks were going away in March and why, why profitless tech is not a buy when the cost of capital continues to rise and the Fed is not cutting interest rates. So there's so many things to think about. I just think that there's probably at this one point, and again, I'm trying to trigger people and saying I'm the only bear left. Of course, there are plenty of people on this call, and a lot of people have really fucked up their hedging because they don't know how to trade their hedges otherwise. But that's not, it is what it is. Like, my long only asset allocation today hit an all-time high. If you didn't, get better. If you don't believe mine, too bad. We have 23 longs. I mean, there are a lot of things to make money in without having to take on the risk of being long, the things that everybody's long, which include Tesla and Microsoft. So it's a really interesting point. And I mean, like, when we think about this, like, from, let's just say, like, God forbid, 6 months from now. I know everyone's market memory now, especially if you're at a hedge fund, is like 6 hours from now. But like, I won't forget. I won't let anybody forget that Tesla went from 400 to 300, going back to 200. Yeah, it's like these are massive bubbles, mother of all bubbles. And again, was that it?
Yeah, that eyeball discount call out is fantastic. So again, for any power user who's been paying attention, obviously that should have been staring at you on the page, right? In terms of the mega caps, it's the only one that we provide on a daily basis that actually has an eyeball discount, and it's come down from a premium going into the print last week from a plus 28. But even then, that premium wasn't as basically those mega caps have been running, Keith, that basically over 1.5 times at a minimum to basically like 2 times on a trailing 12-month Z-score basis, whereas Tesla even a week ago was only at 0.9. So they're just, it had been trading so differently, and sort of the eyeball discount itself, discount on a relative basis, and then now just an outright discount a week later is something where it's like, oh, that doesn't smell the same or doesn't look the same, certainly doesn't have the same data features from what we review on a daily basis like the others. So Microsoft on the other hand still has a big eyeball premium of coming into this morning at plus 2.1 times on a trailing 12-month basis. So definitely will be interesting to see if that starts to wane like Tesla did.
You also have a implied vol discount. Like, the epicenter of the bubbles is really Elon wrapped around crypto, right? Like, so, like nobody wants to talk about this, but I'm old enough to remember like 3 weeks ago when Bitcoin is at like 31,500, breaking out above the moving monkey. And now it's not. Like, even the crypto crazies are the most fucked up of all, right? Like, they're willing to believe absolutely anything that isn't fundamental because they need it to be true, right? Like this is quite literally like watching a bunch of degenerate geriatrics at the casino just pulling on the handle. Like, it's just a dart after dart, believing back to the ATM. And this is like, even the crypto crowd has given up. But the NASDAQ, that's a sight to see. And I really do think that this is going to be, like, again, 6 months from now, 6 years from now. Like, who were the people, institutional investors, that were willing to accept peak multiples on negative earnings? Like, NASDAQ has negative earnings. I mean, I don't know, I don't know, like, there's like, I don't know if that's like new news to people, but people are like, oh, look at the consumer confidence numbers. It's like, look at the consumer confidence numbers in the middle of 2001 when the stock market bends. Like, you literally have to be an uneducated, unsophisticated, blind as a bat idiot when you make these comments, right? Like, I mean, the rate of change data continues to slow. Retail sales in America just went negative year over year. That's the Red Book number this week. Industrial production went negative year over year. That was last week. Guess what? Both numbers are a similar set. Both are negative 0.4% year over year. But we don't need to talk about that. We don't want to talk about that. We want to talk about AI. I just think it's an amazing thing. The
other one, and I saw you were tweeting this today, is that I don't see the recession. I don't see the lack of spending. It's like, I don't know what to tell you, man. But like, it's out there, and you're seeing it in the data because you're seeing negative prints hit. And again, so Keith, I do have.
We have a couple actually in my neighborhood. We have a couple crazies. Like I know everybody on the call has a couple crazies, right? Like in their neighborhoods, you have a couple. You live near anyone who's like a little crazy. So we have. I have one that's an older woman, and one's an older man, and both of their spouses died, and both houses are certified cray-cray. Like all the blinds are shut. The mail can't go to the box. It's got to go to the garage. And it's like everything is shut down. That's when you cannot see, you do not believe. Unfortunately, one has Alzheimer's, and I help, actually, by the way. I walk one of their dogs, and I'm trying. But it doesn't change the fact that behavior is not unknown to human beings, right? Like, where you just shut off the world to what's going on. Like if you were to tell that gentleman that it's raining, he would say, no, it's not. I don't hear it on the roof. You would say, like it's just, we're at the point when it comes to rate of change economic data that is actually negative year over year. LVMH, I think most people, even if they're big timers that love like how their spouse has a man purse or their wife has a nice purse, it's the sales were reported as negative year over year today. Like these are economic facts, right? So, and I think that that's the great glory in the process. And God certainly didn't just issue it to me. It's anybody who has some wherewithal with calculus and understands rates of change. It's not hard. You can just actually look at a picture, even if you can't calculate it. And it's negative. And I just, we're going to look back at this. I will not relent. Some people are like, oh, when he capitulates, that's going to be it. If you think I'm going to capitulate on that when I'm making all-time highs in my long-only account, you're out of your fucking mind. Like you need.
I've only got to know you, better over the course of the last 9 months, and I can guarantee you, anyone who's on this call, that's not happening. But
I had one major client there. It's like one of the biggest insurance companies in America. Actually, he said, and he's the head guy, but his boss, he always says my boss, and his boss is the founder. His boss is a billionaire, and he's the guy who runs the place is he's worth many, many tens of millions. And he goes, man, what I love about you is that your conviction seems to be going up as everybody's conviction that there's a soft or no landing is going up. And he goes, can you just explain to me like how that works? And his name's Jim. He's a beauty. Yeah, and he's got a lot of years and a lot of experience in getting cycles right. I said, Jim, it has nothing to do with my conviction. It has everything to do with the next data point. If the number 2 and 4th ranked feature in the US GDP model just slowed last week, my conviction, I guess, should go up because the data just slowed, right? And he's like, no, but like you keep are you more convicted because more people are bullish? I said, no, it actually has nothing to do with that. It has everything to do with the process. And it was kind of like a good moment. And he's like, our institutional clients, like, to be clear, quite sophisticated, like many people listening to this. They understand rates of change, they understand our model. They're like, okay, at least somebody's going to stay consistent and true to the process. And if I didn't, you wouldn't be here, I wouldn't be here, Hedgeye wouldn't be a thing, right? Like 100% of bear market rallies in 08 and in 02, I just stayed with the process when a lot of people weren't willing to. And that's the specific point where you should. And it's like it's a really exciting time. I'm quite excited about it. I've gotten up earlier this week because I'm so excited.
You can say I'm at 3:30. That's pretty early for you.
I can't wait. I can't wait to see what they're going to sing next. Like Bloomberg's headline 2 days ago said, this was the bear market has been erased. That was the headline. 2 weeks ago, for those of you that shorted the dollar at the low, which was idiotic and not process-driven, purely emotional, you'll recall that their headline was the end of an era for the dollar. Yeah.
And I need to correct, and Keith, I need to correct myself. I said that the dollar, I misspoke earlier, so for those listening in, I said the dollar was bearish trend. It's actually neutral trend. So apologies for those listening in.
I know
it's bearish trade, neutral trend. So apologies.
Well, listen, to a lot of people who are new to this, they still use 50-day moving monkeys. So they still can't reconcile that, right? They still can't reconcile that. They can't reconcile.
I still have to be accountable though, Keith. I have to be accountable to the words that come out of my mouth, right? So just want to make sure. It was bearish trend last week. It moved to neutral on this bounce. So we'll see. But so I apologize for listening. That was my blunder. But yeah, Keith, Trillion Capital jumped up. He's a beauty from Canada, from Toronto. So I'm sure he has a question for you. If you don't mind.
He is a beauty on Twitter. He's like, they're unrelenting people. Now I'm a lot of hashtags. So $1 trillion capital for Canada. Today I invented a new one called recession deniers.
All right, Trillion, you're on mute, buddy, but the floor is yours. Recession denier. Trillion Cap is not a recession denier. He sees the real estate bubble in Canada in full speed. He loves the what was it? You loved the short trillion? Was it? No, it was long Aritzia. Yeah, it was long Aritzia, short goose. He loved the fact that Brian McGough Keith. So that Brian kind of expanded out to some of these individual Canadian retailer names. He was loving that a few months ago. But anyway, Trillion, the floor is yours, my man.
Yes. Well, thank you for all your work. I just came up to thank you, Rob, for this Twitter space is very valuable. And Keith, your work, especially over the last 20 months, the entire team, especially on the call, the last 20 months performance of the analysis and the data compiled, and so the granular levels that you've been able to dissect everything that's going on and circumnavigate this entire market just over the past 20 months in particular is just astounding. And I just cannot believe, some of these things. I mean, I would have never been able to compile all this and execute without Hedgeye's help. And, I learn more every day on Hedgeye than the first, time I opened the Canadian securities course textbook, years ago. I just astounded and I just really appreciate your work and the differentiated exposures. It's just something I would have never really executed on without the team's help. And yeah, the individualized Canadian names, been great as well. And, I'll kind of express different shorts, as the sectors in Canadian companies, here where I can. But overall, I just wanted to say thank you for everything and just keep it up because, it's just really world-class research. And just thanks so much.
I appreciate that. That means a lot. I only knew you on my Twitter stream, which can be kind of a blunt instrument, suffice to say. But anytime I hear a Canadian like it's process, it's data, it's different pronunciations of the same words, and I love it. It's just that it brings me home. I think really, man, like what the main takeaway for me is, like, in terms of trying to improve on all my own faults, is like just stop getting lost in like kind of the panic of the Q on the macro show or in the feedback on the hate on the Twitter stream or the love for that matter. It's just like, let's just keep pushing it forward, right? Like, I mean, a lot of people, a lot of you that, especially if you have some level of experience, and if you don't, we're trying to level you up. Yeah, there's a lot to do, right? There's a lot to do out there. And there are a lot of things that I said to my own team at our offsite last week. I said, look, we need to stop with the perma-bear porn marketing. Like, there are so many things that are working for us on the long side. Like, guys, we have to have some balance. Like, it's not like, because the unsophisticated investor, somebody that has no experience whatsoever, is just gonna, they have no other options, right? Like, they're spy monkeys. Like, they don't know where else to go. So they wouldn't buy Israel, God forbid, never mind India. I mean, they just couldn't do that. So I do appreciate that you appreciate it. And by the way, I couldn't do that with a huge team, because you can't do that on your own. So, anytime I get thanked, I try to thank my teammates, because you can't do this like as Han Solo. That's for sure.
Yeah, and I'm gonna step in here and plug two quick things from the Hedgeye perspective. One is we've got Hedgeye Cares coming up, which is our annual golf tournament. It's our first year back since kind of pre-COVID. So that's happening on September 26th. And then we've also got the Hedgeye regional event in Las Vegas. This is our kind of West Coast regional conference. It's a one-day conference. That is on September 11th, I believe it is. Sorry, I put the tweet in the top. I should know that date. Yes, sorry, it's the 12th. We're doing some activities on the 11th, which is why that's in my brain. But September 12th is the actual event. It's a great time, those Hedgeye regionals, and certainly our opportunities like Trillion just had in terms of having a very frank conversation with Keith and others in terms of sector heads. There are typically about 6 to 8 that present, and then a lot of kind of one-on-one discussions, both pre-conference and post-conference, with both people like myself and Keith. Trillion, back to you, buddy. And then,
sorry to interject.
Yeah, no worries.
Yeah, so I just had a question. I've been using the Tier 1 Alpha since before it was integrated into Hedgeye, but I think that's a great value add. That combined with the call is just really ultimate. But in light of that, with the volatility suppression and that, Keith, do you see more of a chance the more the volatility is suppressed, as you always say, as you allude to, the holding a beach ball underwater, do you see something in the financial plumbing snapping, almost like a 2020 event style happening as on the micro show, Daryl Jones was alluding to? Thanks.
I do think, and again, part of like when I said, I don't know if you caught the point where I was saying, like when I was ranting about like, was that it? Like, was that it for AI, the NASDAQ and all that? I mean, what I'm really looking at, in addition to the components that I mentioned, is NASDAQ volatility. So the big ball underwater isn't the VIX, it's actually the VIXN. So VXN, which is NASDAQ volatility, is listed, so you can model it, try to model it on your own. But I'll tell you what my model says, which is today was a big higher low for vol. And it was on news, and it was on Microsoft. And when you look at kind of like the machine, and the machine's inputs are quite interesting, because again, I think 90% or more of institutional investors that we know and or Hedgeye Nation people were either long Microsoft outright or definitely weren't shorted, because this bullish trading trend signal. They got the prior quarter's revenues accelerated, pod 1 acceleration, so that's good for them. But on a day like today, where that thing is down 5%, making lows into the close, new lows, intraday lows, and NASVOL is holding above like the critical threshold, which is 18. It's at 8. It closed at 18.99. That is the ball underwater, because that's the whole shooting match, right? Like as soon as you kill the generals, then the war has been lost. And there are many, many battles, many of which I've lost. I have a central tendency not to lose the full investing cycle war, but this is a critical point for volatility. And I do think that that's tomorrow. What's great about, and if you don't mind me asking, do I know your first name? Because it's kind of like I was like, when I talk in trillions, I'm going to start to be.
Oh, yeah. Sorry, my name's Pat.
Okay, yeah. So Pat, it's like, Pat. So my new drill, like I get all my team forever in a day. All their vol data that I get starts at 7:30 when Bloomberg data resets. But Craig, who's like the head guy at Tier 1 Alpha, he sends me a fucking email at like 1:30 in the morning, right? Because he's in California, so for him, that's the end of his workflow. That is awesome. Like I get to now look at what I just said on NASVOL, and I get to contextualize it with the tier 1 alpha data, which is all, really, an analysis of gamma, dealer positioning. These are huge things, right? And they're huge things that are constantly being manipulated out of city centers called New York City and Chicago. So it's gotta be really interesting. Like at 1:30, why my wife's like, why are you up? It's 3:30 in the morning. What are you doing? And I'm like, I want to see this data. I want to see this new data that I get every night. And I do think you're right. I mean, there's a reason why people follow tier 1 alpha. There's a reason why Mike Green is one of my top contacts in terms of contextualizing flow. There's a big time reason on why I've been trying to communicate there's a difference between flow or Brownian motion in particular in this day and age and the actual economic cycle. So yeah, I think that this sucker is going to rip. I mean, the NASVOL, every time it goes to 18, it goes back into the low 20s. And I think this is it. I mean, what else do you need? I mean, all you need is Apple to tell you that they're impacted by China, Europe, and USA slowing. I don't think that should be a conceptual surprise for anybody. But we'll have to see.
I'm a little giddy over here, Mass, that I think I front ran a top 3 things tomorrow on the macro show. There's volatility.
That's a big one. By the way, on Apple volatility, VXAPL. That. So I like everything. So when I'm trading Sally Beauty today, I have VXS Sally Beauty, right? Like I don't give those up, but you can look up VXAPL even on
like sitting at 25 and a quarter.
25, like not 18. It did get, when you go back to the mother of all bubble highs, I think it was definitively on June the 15th, because that's when Apple volatility was in the high teens. You had the most call buying in the history of humanity. I always show the chart. I've tweeted it multiple times, but it's like exhibit number 1 in the current macro themes deck, where we show on the one side AI mentions, on the other side S&P call buying. Like there wasn't a day in U.S. history where you had that level of bullshit, right? And Apple agreed with it. But now, instead of being at 19, Apple volatility is at 25, and it could go to 35.
Yep.
Apple 35 vol day is so much more important than Fed day. I can't say it any other way. I mean, it's just like a critical thing to watch. So, and the risk range of vol on Apple, so tasty. It's like I can't get it much below 24, and I can easily get it to 34, 35. So, or the math can. So these are the days of our lives. I mean, this thing is like literally watching a bunch of fucking idiots walk right to the edge of a cliff and say, we're good with this because we need to perform. I mean, I think that's all that's left.
Yeah. No. Yeah, that's VX Apple. That 35 would be a new 1 month high too. So that'd be something special. That's for sure.
Well, if you got the 27 to be at a 1 month high, it's gonna take much.
Yeah,
I know. I'm just using here. Yeah, exactly. All it's gonna take is if and I would, or I mean, it's easy to actually argue that Apple is more cyclical from a consumer discretionary perspective than Microsoft, because Microsoft has the institutional or corporate business, and the acquisitions and all that bullshit. So really, and
yeah, the just in terms of Tier 1 Alpha. So I mentioned earlier that I was going to pin their tweet. It's up in the nest up top there. So you have the Tier 1 Alpha commentary on the 12 billion of vol that's out there in the next couple of days. And then again, if you're interested in joining Hedgeye, the Hedgeye regional event in Las Vegas on September 12th, that you can click the link up there in the nest, as well as if you're in the New England area, we'll be hosting it at the Hedgeye Cares golf tournament at Keith's home course at Glen Arbor on September 26th. So all those links are up in the nest. I've got one of your favorite guys up here, Keith, which is Mitchell Krause from Other Side Asset Management.
Oh, nice.
Mitchell has been both the Hedgeye Lab events as well as Hedgeye Regional down in Miami. And so Mitchell, welcome to the show. You're not a first-time caller. You're a multi-time caller. How we doing, boys?
Hey, man.
Doing great.
So I just long night. I didn't catch the beginning of it, unfortunately, but I wanted to tag on to Pat $1 Trillion for a second. I just finished up my monthly note, and I kind of made it a point to utilize everything from a chart standpoint to tell the story as published openly and free from Hedgeye. So I bookmarked countless charts, graphs that you guys have shared for free. And I think I have anywhere out of 16 charts in the monthly, I think 12 of them tell the story from Hedgeye, and I link everything back to Hedgeye's Twitter, whoever's Twitter feed put it out, right? Whether it was Ed Skyver or you or the Hedgeye handle or whatever. And in the note in particular, I'm in awe as to how much free content you give. Like, obviously, I'm a paid subscriber. I'd never break a paywall, etc. In this scenario, I'm trying to show how much content, how much of an education, I think I refer to it as a better than PhD education, just to follow them. And it's really just amazing. Yeah, well, I don't know. We'll see how the note reads, and we'll see how people like it and how well received it is. But at the same time, it's literally just boom, 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 and you just tell the story with the images. And you guys just, and I don't want to put words in your mouth, but I think you're trying to prevent people from losing an absolute fortune, which is probably why you're doing it. And that was my guess in the note. But you guys literally have put out so much content in the last 3 weeks to try to protect people. It's to be commended, in my opinion. So yeah, I missed the first half hour, so I don't want to jump in and ask questions that have already been asked. But yeah, thank you guys. I appreciate it.
Yeah, that's cool. I mean, that's the goal. It's always been the goal, right? It sounds obnoxious because it is, like to say, long only account hitting all-time highs for 2 days in a row, and it's going to hit another big all-time high when we get our payouts, depending on how you've all expressed your cash position. Obviously, you get a 5% yield on it if you're doing it properly. For me, it's FDRXX. So I know my pile is going to be at the peak, and I know it's obnoxious to say it, but I also know that it's important to make that point, because if it wasn't doing so, I'd also make the point. Like, look, I'm getting my ass handed to me, et cetera, et cetera. But that's just a tactical point, Mitchell, right? Like, the real point is to make sure people don't, just like 20 months ago, lose 20, 30, 80% of their hard-earned capital. So yeah, we picked up the pace recently. Yeah, there's also a sophistication and a triggering to it all. Like last night, I knew when I put up industrial production and closed the chart at the year during the pandemic that people were going to be like, "Oh, you stop!" Like you people are so fucking stupid that you deserve to lose your money. Like, you really are, and that's the point, actually, right? I mean, the point of industrial production to show the last 3 big industrial production recessions is that 100% of the time they brought them into a full-blown U.S. recession. So that's 100%, right? Like, so if you can't think for yourself and take the most recent industrial production data point and understand that it's just getting started, then that's really on your own myopia or your lack of education, macro unawares. So to a degree, Mitchell, like, we're putting a lot of content out there, but it's only for people who actually know what they're looking at. Right? I mean, and again, today I showed the last 7 industrial production recessions, including this one that we've just entered, and then the rest of the story. But I mean, everybody who pays us knows that. Everybody who's getting it for free, I'm kind of trying to, in a sense, like, reveal their lack of awareness so that more people are aware. You see what I'm saying? Like, so it's like, it's a strategy. I'm trying to, like, say, okay, listen, You guys are like, it's like me. It's like Keith McCullough going under the hood of a car. Like if I go to Pat, who sounds like he might know some things about cars, maybe not. Or if I go under like the hood of a car, of a truck, or I go try to operate on your spleen or your teeth, I'm fucked. I don't know what I'm doing. So why would I every day on Twitter purport to know exactly what I should do with like your crown moldings and or your carburetor? There's no way, right? Like there's no way. So putting it all out there too is like, you see it because you understand the process. So you find value because you understand the process. My guess is, Mitchell, and it's sadly, at least 80% of people have no idea how to contextualize what I'm saying in the morning.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
Can't argue with you there. One of the things I tried to do is contextualize it and tell the story based upon the images to try to help those who actually do. I think that there are people who are just haters and who just want to complain and bitch and moan. But I do think that there are genuinely some people who want to learn.
Yeah.
So if they rip through it and they want to learn, all right, well, here it is contextualized. Roll. But you guys are doing a hell of a job, in my opinion.
And I've been consistent. And some people, like in Hedgeye and ASI, take it as a compliment. I think some of you are saying it back to me when I say there are really only 250,000 human beings that can really like absorb this, both from an EQ and an IQ perspective, and really understand what's going on here. I mean, to be clear, if we ever have 250,000 paying subscribers, like, first of all, I don't need to work a day in my life again, and that's not big timing anyway. So I do this because I love it. I get up because I love it. I want to help people, and that's what it is. But I do believe that there is a significant gap in terms of people's ability to evolve, change, and or think this through. And I'm right on that. I'm validated on that every day. Just look at my Twitter stream. Like, you have a bunch of bozos that literally constantly talk about what the SPOO's return is, who are an entirely different group of people that obviously didn't rattle that off last year. So, it's an opportunity for all of us. In a way, I want to try to reach as many people as we can, because I really, in phase 3, really don't, the clock's ticking, right? Like this might be it. Like this, all I had to do, like Microsoft could have easily, and you followed it closely, Mitchell. I mean, they could have easily said, our Azure business is going to reaccelerate to 35% growth, but they didn't. They said it's going to continue to decel and we don't know where to. They could have said, hey, AI is going to be $1 billion next quarter. They didn't. They said 150 million. Like, I didn't tell these companies what to say. They just told me these things. So these things are new. And that's why I think this could be it, because it's such a bullshit narrative.
Well, thank you very much.
Yeah, and just for those that may be interested, Mitchell's writes a monthly note. It's free on his website, but he's also a guest author on our site. So when those go live, we publish them as a log post, as a kind of a guest post there on the Hedgeye site. But again, to echo Keith, your point, Mitchell certainly also believes in that same, I guess, same vein in regards to his note is free. You don't have to be a client, even though he does run an RA. He just makes it available so you can get that in your inbox. But he's also been kind enough to allow us to post it on our site as a guest author, which has been fabulous for the last couple of months.
Right. You guys have been very gracious and kind with that. It's with my web guy right now, so it'll probably be out early in the morning.
Awesome. Cool. Awesome.
Yeah, Keith, I know it's like 9:30, which is typically your bedtime. We got a couple guys that jumped on. Connor is a younger guy. He's a great I guess a real Jedi. He's really dove into the process. So Connor, I'm gonna pass it over to you. Maybe you have a question.
Hey, yeah, hi Keith. If you could have either your 1:30 a.m. Tier 1 alpha data or the monthly quads, which one would you rather have?
I mean, monthly quads. I mean, I'm pretty sure, but Keith's on mute, so we'll circle back up to that one.
No, I'd say that one. Sorry, my bad, the wrong way. I'd say that it's like picking between my children, right? Like I can't, but I have 4 children, so there'd be 4 different options there, and I would never pick one. I mean, the whole point of the process is that none of it makes sense unless you put it together, right? Like, so, like the options, the flow data doesn't matter if I don't know where the probability of the quads are. The probability of the quads don't matter if I don't know where the flow data is. So this is, I know people want to, it's like Occam's razor. You want to simplify it to the point that it's so easy that you could use a 50-day moving monkey and understand how to do macro, but that obviously doesn't work. So I need it all together, and there's a rhythm and rhyme to it, and there's a dynamism to it, and we're learning in real time. Like, I think there is a massive amount of manipulation, legal manipulation, which has a lot to do with the fourth turning. There's no prosecution on people getting, if you're worth hundreds of millions going on hundreds of billions, then there's no limit because you pay the political bills, right? Like, so I think that this game is being gamed at an increasing rate. And I think that the revelation of that does come into my email at 1:30 in the morning. But at the same time, I'm a staunch believer in gravity. So I do think that the quads will win in the end, and violently so. So we're going to have to see on how that all, comes together. I think, I know a lot of people get upset, right? Like, and like, look at the chart I just showed on NPW. I'm like, I feel so bad for you. The stock went from 21 to on its way to 0, and it just bounced. But let's just look at a picture of what we're talking about here. I mean, this is classic bear market, just like crypto, just like Bitcoin. Bitcoin's down 57% from its all-time high. And it's quad 2 high, which is more important. But MPW this is just like panic attacks. It's inexperienced people feeling like they're not going to get the next move, and it's always the other way that they're concerned about. And I get it, but and I get that I screw up real-time alerts, and I screw up life, and I screw up a lot of things. But I so far have not screwed up cycles. Like, I stay with it, and I think that this is, again, just to get back to the answer to your question, I would take both, because I think that it's highly informative for me, at least. Like, today literally was the first day I went to net short in how many days? First day that I hit the red eye in how many days? Like, there's a reason for that. It's because I understand the flow of it better. I understand the manipulation big time, and I'm not gonna just like wear it like some idiot. Like, I'm gonna professionally risk manage it. And I think that we may have just got to the point where this whole thing flips again. We'll have to see.
Yeah, thank you. And is that just about the time that the dollar's kind of calmed down? I mean, you still, are you looking to buy the dollar if it goes bullish again? I mean, I know that's a part of it, sticking to the process, but
well, the dollar
have we run the cycle, or can it accelerate?
I mean, the dollar only has one quad. Again, there are a lot of like things that are in my head that are just givens, right? Let's like, if it's raining, don't take my 100-pound golden retriever out, because then I have to dry them on it. Like, if it's not quad 4, then I'm not probably buying the dollar. Like, what we're talking about is a mini quad 3, right? So quad 3, dollar at best is neutral. It's certainly not bullish from an immediate term trade perspective, which it would be in quad 4. So I think, for the next month or maybe 2, you could have these quad 3 dynamics where the dollar is range bound and not something like, I don't own it, right? So that's the most obvious answer to the question. if I thought it was going up, I would buy it. On this bounce, I actually sold it literally at the high of the week, and that was a good decision. It was down today. Good short-term decision. I look at a lot of short-term decisions for what they are, covering Australia, doing that, buying Israel. There's a lot of good decisions. If you make a lot of good decisions across the span of your full investing cycle life or across your life in general, you'll be happier than if you make big, bad mistakes. So that one on currency, I think, and by the way, that's very bullish for gold, and why the grossing up with the gold position is far more important than having no currency.
And orange juice.
Orange juice it's a thing. So every morning, and two, like when I said I was excited to get up at 3:30 instead of 4:30, I have tier 1 alpha data coming in. I have a big time commodity market to analyze right now that has everything from orange juice to sunflower oil, etc. It's like there's a lot of heat in these markets, so it takes me a little bit more time in the morning. So I do need to get up a little bit earlier. But that inflation reaccelerating on a weakening dollar, so a dollar not breaking out is just amplifies the point, right? Like the Fed, Powell just told everyone today that if the CPI is up, I'm going to raise rates again. They didn't read it that way. They tried to, and then they didn't. And then he said, well, if it's not, then I won't. But that's the whole point. Like, why do you think I'm analyzing sunflower seeds? Or orange juice? It's so that I get this right? Because I want to get the big moves right. I care about every short-term move, but getting the big move right, which is the Fed staying tight, tightening again in September, and potentially alluding to another rate hike in November. There's so many people that are going to lose their shirt if that happens, and one of the people is not going to be me.
Yeah, I think it was clear to most of the people on the call that the dollar was at the top end of the range. I feel like it's sort of back at the 50-yard line, and with the dollar at the 50-yard line, is that's where the inflation is really going to pick a side.
Yeah, it could. And the winner on the other side of the 50-yard line is gold and precious and gold miners. And today I added gold.
Yes, I was just going to make that comment. When you added the end.
Right. So I'd encourage all of you to, and this is a common mistake, but a very common area of potential evolution and improvement. Many of you don't run a proper diversified long short book, and you get wedded to positions. You take way too much risk in short-term positions, and you gross up and you pick a couple horses, just like you would if you were to go, bet on the ponies at Saratoga. Stop it. Take a diversified approach, have max mins, have incremental touches, and go with where the game is going. So currently, a neutral dollar means we're going to get more aggressive on precious metals on the long side, more aggressive on EM equities ex-China on the long side. We're already led with all this, right? Just find the game. Stop with what you think is the one thing you've been trading, or you've got to get back to break even or some stupid shit like that. I've made those mistakes. I'm criticizing you for that because I've been you. Find the game that is developing and increase your allocations to that game. Currently, this is the point. The dollar neutral as opposed to breaking out to bullish, it was a nice counter trend move to the downside and then a nice lift off the low. That's it. It's over. Get over with it. It's like a nice date. If you're single, you understand it. Just get it out of your life. Find something else to deal with. It's not something that you're wedded to. It's not core to your portfolio. It's not something you have to wake up every day banging your head against the wall on. So that's, I think, the most important thing. This is, again, it's the inflation trade, it's the energy trade, all the way down to the next thing I do is buy small cap energy. There's so many things to do with that on a neutral dollar that, you can obviously see it if you're paying attention. And for those of you that don't subscribe to Macro Pro, I don't want to apologize for that. This is what I do, right? This is what I do to feed my family and the firm, and the top end of the funnel, which is where we get paid the most. Macro Pro subscribers know what every single one of these positions are, and they're largely reflective of a dollar that is probably done going up and may not go down much.
Get that. Thanks, Connor. Good commentary, buddy, as usual.
Let me ask one more thing. So Keith, definitely can't afford Macro Pro, but I won it in your contest. And so on slide 16, I was wondering if we could get the US GDP Nowcast ranked by the features. You mentioned that the first and the third, or the first and the fourth ranked feature in the model came in this week, but I can't really tell the rows apart. Could you sort that for us?
It's there.
Yeah, it's there. So
they're in parentheses.
So on right beside each feature, it's in brackets or in parentheses. It has what the rank is. So under retail sales, it says 4. Under industrial production, it says 2. So those are the ranks. The marginal impact on the model of each rank.
Yeah, and I use those. So it'd be easier to consume with less and less time in the day if we could rank them as they move up in features.
Yeah, they don't move up and down in the day. They might move once a quarter. So you're asking for something to be easier that isn't something that needs to be easier. It's something you shouldn't even worry about.
Yeah, they don't like. I think I've been a subscriber for 3 years. Again, I'm not that old, but I think Real PC has been number 1 that entire time. So yeah, Connor. I mean, there's there, buddy. I wouldn't really put too much. Yeah, I wouldn't bang your head over it, man. There's a lot of other stuff to go think about.
What I like about this, though, is that the guy Connor are paying attention to. I mean, these kinds of questions are like you got to ask, right? It's like me asking where the clutch is, and I can only drive automatic, which is kind of an embarrassing thing to say for.
Wait, you can only drive. You don't know how to drive. Hold on a second. You don't know how to drive stick. You're from Thunder Bay, Ontario.
Yeah, I just admitted it. I have so many issues, but I really, but there's a good example. Like I really don't question the automation of a car because I don't have time to. Yeah. I just drive the car. Like, I mean, I accept that the car that I drive, is well constructed and certainly will get me to the goal. And I don't really call the guys in Germany at BMW and say, hey, look, where do you rank the fuel feature versus the exhaust feature? I mean, I'm good. I trust you. I'm good.
Yeah, Connor. Yeah, you did win. Yeah, you've got Macro Pro, right? At the moment, that was like me.
Yeah, and I'm looking at it because
leveled me up. Hedgeye was kind enough to give me that before I was came in house, and that was an absolutely phenomenal moment to really just soak it all up. And Connor, I know you and I emailed, so I know you were doing that, and you're absolutely taking advantage of that of this kind of quote gift. So well done, bud.
And that what do you ask?
Yeah.
To like I had a call this week. One day we did 5 institutional research calls. What most of you, if you have 401ks or whatever, you're allocated to this fund that, in particular, that I'm going to cite, but I won't name names. And the CIO quite literally started telling me that I hear you, Keith, on the second ranked feature in industrial production growth. It's a great point. It's negative 0.4. But I was talking to my friend who runs a hotel chain, and their business is just good. And I'm like I have to answer that. It's like there are 30 features in this model, and not one is the guy who's a member of your golf club that said that to you.
Don't own some hotels.
It's crazy, right? People go crazy for their compensation on Wall Street. So what I'm most proud about is a guy like Connor is learning, and he can gas those questions and know that the features are the features, and that's what determines the probabilistic outcome, right? David Salem can tell you that that's the best hack that exists in macro, and the most sophisticated investors in the world can ignore it for the sake of quote unquote chasing performance so that they get paid this year because they didn't last, and still fuck it up big time. Like, I think that this is actually the liberation. Like, the phase 2 of Hedgeye risk management is getting people like Connor and everybody else to be as good as the guy who's running $1 trillion. In fact, better. And I know you can be better because that's a stupid thing to say. Like, you don't come back at me after I give you 162 slides in a deck and tell me what your golf buddy told you on a course about his 2 hotels. I mean, it's like almost like I don't know. It's insulting.
Yeah. Yeah, I didn't have a chance to tell you. I had a good initial call with somebody today, in regards to what we talked about last week. So they're going to come back to me next week for me. I'm excited. I'm excited to kind of be able to see where this goes. But yeah, we'll keep that in house for now.
Yeah. And by the way, I gotta go to
yeah. No,
so I'll let you guys keep going. Apologies to Hijack.
All right, thanks, guys.
Yeah,
I didn't mean. I think that I appreciate you. Thanks for jumping in. We'll see you in the morning, bright and early. And yeah, no, appreciate it, bud.
Thank you.
All right. Leo, Muni guy, I know you probably jumped up to ask you a question, but I am here. I'm kind of like I'm another mucker, just a different kind.
Yeah, I'll pipe in. He's still listening. I actually was going to ask him his favorite place in Ballycastle, Ireland. We're actually heading there in September, so I was going to take some notes down for that one.
So I'll tell you this, so he may pipe back in, but he liked Ireland so much that there's already a golf trip 2.0 for Ireland scheduled for June of next year. So that's I've gotten a soft invite as of a happy hour last week. So so he definitely was a big fan of golfing in Ireland.
Yeah, no, we're playing one course there. We're going for a wedding. We're staying 4 days in Ballycastle.
Nice.
And then 2 in Dublin, and then 2 in London.
Okay.
So it'll be a fun week. It'll be weird getting used to the East Coast or the time, but make it work.
Yeah.
But yeah, no, that was mostly what it was about.
Awesome, Leo.
Nothing too serious.
I love it. Any guy. All
right.
Robert, how are you, bud?
I'm doing very well, thank you.
Good. Sorry, I'm late getting on here. Tonight was what I call the meta steak. Crushed meta, and took my kid out.
I love that.
My oldest son, who's home for college, out for a steak, and came back, and I was like, "Whoa, we got a good one tonight."
Yeah.
Couple things. One, this is what I signed up for, man. This is old school. Keith on. We're missing Mike T. But when I joined Hedgeye, be 2 years come November, this was it. Like, Keith would get on, Mike Taylor would get on, and it would be talking shop. And it's just kind of like I just saw this and was like, man, this is old school. It
is old school.
This is it. This is like as true as it gets. So appreciate the space. The second thing I wanted to say is
like, now I get to go in the office, a couple times a week, and
that's right.
Calls he's buying, and I'm like, all right, buddy, appreciate that. So
that's right.
He hasn't taken my advice yet, nor does he ask. So, but anyway,
I get it. The second thing I wanted to say is, I like to play the opposite side a little bit in order to just kind of get conversation sparked and then bring it back to the real. And to me, the real is what I call risk adjusted return. And you can play the mother of bubbles and all this stuff this entire year, but at the end of the day, when you risk adjust it, it literally doesn't make sense. And hats off to those that played 7 stocks and did what they did. But like, for the long game, if you want to survive a long term, that is not the route to go. And so for me, I just kind of step back and I just look at the whole macro, and I always praise the macro piece of Hedgeye because I love the macro and I love to create, a macro pro, but I actually like to create my own macro strategies as well. But at the end of the day, man, if you don't step back and take the macro and then look at your, as Keith likes to call it, the pile, look at your, how much investable assets you have, you're doing it the wrong way. You literally are. And earlier this year, I think it kind of got lost at the Minsky moment. And I just, as we continue on this path, we're getting closer to that Minsky moment. I think everyone sees it. Everyone was waiting for Pac West to go under. Pac West didn't go under, but they're being acquired. I mean, all these things seem to indicate that we're at this next inflection point, and there'll be a snapback. So I hand it off to the bulls for this period of time, but from my perspective, as someone who's extraordinarily conservative, loves Hedgeye, loves the macro, and likes to a little bit be an antagonist just to get people to think, because I think a lot of people don't think. I just wanted to say that I love what you guys are doing. I love the fact that, this is getting a little, I even see Jimmy runs money here. I haven't seen Jimmy in a while. I just love the fact that maybe we're at an inflection point here, and it's good. This is good for the long term. It's, short term, people can have what they want, but if you want to last for long term, you've got to actually risk adjust. And I think that's what's lost in this entire 2023 is risk adjusting this entire macro drop that you're about to have. And whether it happens tomorrow or it happens in 1 or 3 or 6 months, the writing's on the wall. So I don't really have a lot to offer tonight. Normally I prepare my comments, but
okay. You want to speak?
I just want to. I just want to say that because I like to be a little bit of an antagonist, but I want to preface it with the reason I do that is I want to spark conversation, and I want people to think like maybe this isn't as rosy as I'm being told. So I'll leave it at that, and I really appreciate you guys.
No, Brian, it's always a pleasure to have you on, and you and I speak offline, and so I'll. There's one thing going to come back to you, but basically, data. What from your commentary, what I want to just reiterate is that data doesn't lie, right? So economic data doesn't lie. You can navigate these flows, and then I think that was a big takeaway of mine tonight from Keith, and something that we've been paying. If you've been paying attention, it's been a shift that's occurred over the last, many multiple months, really since the beginning of the year when zero DTEs really started to kind of quote unquote take over a lot of the kind of daily, flow of things, and then how dealers had to position, et cetera, et cetera. I mean, Keith was absolutely, and the team at Hedgeye was at the kind of front and center of that, and recognizing how, what was going on and how to try to adjust and pivot and all that kind of stuff. So, with that said, again, I mean, going back to like fundamentals in terms of the quads, when you can overlay both like the flow and the market data, it's just it's just elevating your game across the board, and I think that's a really crucial piece.
Yeah, and I'll just say that as somebody that is in the municipal bond space, we sort of default to the risk-adjusted return. And, you may make 20% one year, but you risk adjust it versus, 7% every single year. And it's different. So when you risk adjust the return, to me, that's the piece that I take home for 2023. They can all jump and scream. And I have friends that, they're all in triple Q and they love it all day, but the risk-adjusted return doesn't lie. And so I just, I'll leave you with that. The risk-adjusted return.
Kind of provide for those listening in was when you and I talked a few weeks ago in terms of you made a move in late 2021, I believe, or might have been early 2022 in terms of your kids' 529 plans and moving those primarily to cash.
100,
right? 100% to cash, right? And so even with this,
7% benefit.
7% benefit, even with this move here, as we
gonna get better.
As we go 7 months into the year of 2023. So let's see where we finish off the rest of the year. We've got 2 quarters left, et cetera, et cetera. More economic data is going to roll in, and the companies are going to have to continue to report their earnings and what's actually happening out there in the economy, in the global economy as well, right? So that's again, I mean, going back to the beginning of this conversation in terms of where we're pivoting our portfolio to gain exposure on the long side is EM ex China, right? So it's places like Japan, South Korea, India. India's signal strength is probably one of the best out there around. It's Brazil. It's we covered the Australia short that we had on. We've covered much of Europe as well. Just again, that could be a function of the most recent conversation here that we've had in terms of the dollar, right? We get a little bit of dollar weakness or even just dollar going sideways, could benefit the euro and could benefit a little bit of the EU, but at the same time, their quad outlook looks as bad, if not worse, than the U.S. And Keith addressed the question today on Greece as to listen, price action has been really good on an ETF like GREK. So why maybe what's happening there? What's the signal looking like? And sometimes the signal doesn't match up with like the fundamentals. So it's like when you can go play in areas and have go anywhere a diverse sort of portfolio of pieces of inventory that are making up your overall portfolio, like why go play and why go try to chase a Greece when you can be long Japan, which we've been long since April. Why not go be long India and et cetera, et cetera. So that's and that where those countries and those signals match up with their quad 1 and quad 2 outlooks for the next few quarters. So good commentary, bud, as usual. So appreciate that.
Thanks, Robert, man. Love you guys.
All right. So,
I see Mike T's out there. Maybe Mike T's going to join you. Take it for another hour.
To wrap up. It's like I've been on here for an hour and a half. Mike T coming into the building.
Mike T is ready.
Mike T is coming to the building. I'll go to Jordan. Jordan's got a question here, so we'll see if Mike T what jumps up. Jordan, welcome to the program.
What's up, Robert? Hey, how you doing,
man? Hey, good, bud. How are you?
Yeah, I'm doing good. I got my family on vacation here in Colorado. We're doing good. It's a good night.
Sick. That sounds awesome.
Yeah, it's been a good one. Hey, I was just going to talk to you about industrials. I'm just getting back to the notebook a little bit. We've got industrial production down, right? We've got the negative numbers there, but it seems like over the last few weeks, industrials have been just like up and to the right, and that's fine. I noticed that Keith covered a little bit, and I was just curious: are you guys viewing that as part of just what's going on with flows, or is there something fundamental going on there, or do you still have like a negative outlook on industrials in general? I guess that's kind of
good question. So industrials are still on in ETF Pro on the short side, right? So definitely still have a general negative outlook.
That's the other thing. I noticed that he took them off of the risk ranges.
Yeah, so moved them off the risk ranges, but still reporting, still currently a bearish trend component there on, I believe, as of this morning. Let me just double check on that. I already screwed one risk range up today. Let me just double check that and fuck that one up too. Nope, I'm good. Bearish trend. Still bearish trend on that. And so listen, it's part of the FIR, right? So which is financials, industrials, retail and real estate in regards to the four kind of general sectors where we think have the most sort of like downside risk coming, or as sort of the economic data starts rolling in and economic kind of reality starts to set in. So I think what's happened in XLI, as to be specific, has been at least temporarily a sort of like winner in regards to this quad 3 inflationary component, right?
Okay.
So you're getting you're getting some flows and read through in regards to them being able to kind of like take price again, and so maybe their margins and earnings aren't quite as bad as maybe had been expected as we were coming into sort of like late Q2, aka kind of end of May.
Yeah, at least maybe the expectations for those things, right?
Exactly.
Yeah.
I mean, so if you think about like a quad 3 in regards to like how they back test, if you go to slide 8 in the macro themes deck, or it's in the macro show as well, in terms of like the highest and lowest expected values by quad regime. In there, you'll find in terms of best equity sectors, utilities, tech, energy, industrials, consumer discretionary. So again, like with these like mini quad 3s that certainly appear to be happening in July from an inflationary standpoint, and then potentially moving into August as well, that's kind of going against us there in terms of that. Again, just thinking about like them being able to take price and not have to sort of compress the margins. But again, like,
that's very.
They're going to start, but they're also going to start to report reality.
Yeah,
very soon, right? So
totally.
A couple companies, I believe, have reported on the industrial side. And if you're listening to the call, they, like this morning, for instance, Jay, I believe it was this morning, it might have been yesterday. Jay talked about how I believe it was a transport company. I forget which company it was in particular, but how they kind of basically massage numbers.
Yeah, yeah. Was he talking about Knight Swift, or was he talking about one of the other ones?
I think it was one of the other ones, but again, it kind of like massage numbers, which helped the margins, this quarter. But in reality, they're not going to be able to do that again. Come once they report Q3. So again, I think it's going to just sort of, this could be a situation with industrials where just it takes a little bit of additional time with this sort of like mini quad 3 dynamic that we're facing to sort of play out. But it's part of the fur, as Keith likes to call it, right? The financials, industrials, retail, and real estate. So definitely an area where we remain bearish longer term. So again, I think this is I've talked about this a lot on review, Jordan, in terms of time horizon and investment horizon and what's transpired. Obviously, this XLI has gone from 97 to 110 in the course of the last basically 2 months. So it's been a huge move. Something that I'm not going to shy away from. It has not. We've had on the short side. It has not worked, right? So it's there's nothing I can really do about it. So, but if you're sizing your longs and shorts appropriately, hopefully the loss in XLI is being offset by kind of EMX China or uranium or things like that, right? So
Oh yeah, no, just on the feedback, everything's doing great. No, I was just curious on that one specifically, and mainly just because the industrial production numbers come back poorly. And yet I see industrials climb every day, and I'm like, I kind of get everything else that's going on, but that's the one that's kind of, I guess it's just not made sense in my mind why the moves have been. I guess they just seem mechanic, right? And that it just seems like it's kind of up, just maybe 0.5% every day. It kind of nicks away a little bit.
Yeah, no, agreed. So, and listen, I'm looking for it to kind of put in basically a new high today, most recent high, and so I'm really looking forward to put in kind of a higher low, and once it does that, it's going to be one that I'll go to the wood on in terms of
looking at the longer term when they have to report Q3 earnings, and let alone Q4, right? So, yeah.
Hey man, well, thank you, and thanks for what you guys are doing.
Absolutely.
I appreciate it.
Absolutely. Enjoy your holiday in Colorado, buddy. And thanks for tuning in.
Well,
appreciate it.
All right, man. Take care.
All right. So we're going to go to another Mike D. I want to call you a big dog, but
God,
well, I call you. I'll not call you Mike D. We got Taylor in the building. How you doing, buddy?
Thank you very much.
Are you traveling? Are you at a track? Like where are you at?
I am at Indianapolis.
That was really poor English on my behalf, by the way. Where are you at? No, you're in Indianapolis?
I'm at the mecca of sophistication. I'm between rows of corn and soybeans. I'm in India.
Awesome. So you're just analyzing all the commodities in real life.
Yeah, corn's got a problem, but that's South America has a big bumper crop, so the U.S. is going to be screwed. But I gotta talk to my ag guys to figure that out. But I don't even know if I'll trade it. I hate commodities. I just follow it because I swear to God, it's just like gold. I'm never gonna get that crap right. So it's a zero-sum game, and it all seems so easy in retrospect. But I just won't do it. Keith does a better job. It's really simple. Like, signal and trend, and like, what are the facts? And then that's it. And he just puts it on and forgets about it. Like, I have great difficulty getting that right, and I don't know why. So,
but again, that's why you got a good friend in Keith, right? So,
yeah. Well, I just do stock.
Yeah.
As they ask me, like, well, when do I get long gold? What do I do? And I'm just like, I just can't do it because every time I look at gold, I'm like, oh, that might be interesting. But there's so many other better places to have bets on than gold. Companies with fundamental events that are happening long or short. And so I just can never get my money into gold because I just have better alternatives everywhere. Now, if you're kind of like a person who doesn't sit in front of a monitor 12 hours a day like me reading, maybe that actually gold does make sense because, it's a thesis that can work and it can work well. It's just, my day job, aside from traveling around the country racing, is reading and trying to figure this stuff out. So speaking of trying to figure this stuff out, first of all, thank you for having me on. I really appreciate it. And I apologize. I haven't been on much at all. I've been very quiet for a number of months. Pricing power.
First of all, it's okay because, first of all, we're long pink and it's been an absolute outperformer. So very well done, my friend.
Thank you. That is my job. And for those of you who don't know, I'm the portfolio manager of the ticker PINK, P-I-N-K, and it is a healthcare specific actively managed fund. And my goal in this is to outperform my peers. And the peers that I really keep an eye on is the Fidelity Healthcare Fund and the T. Rowe Price Healthcare Fund. And if you'd like, you can take a look at those and compare it to Pink and draw your own conclusions. I'm not allowed to promote or say anything about Pink except that I run it. And I think that's the extent of what I can say without getting into it. Because there's always ears that the phone will,
We'll leave it at that. But I just want,
Yes, that's what I say. You draw your own conclusion.
Yeah, perfect.
And I'm very happy to do that. And all the fees associated, the profits of that fund goes to the Susan Komen Foundation for Breast Cancer. And as does my compensation. I do it for no compensation. In fact, I do pretty much everything for no compensation,
including being on this Spaces.
Being on this Spaces, and I'll share a secret.
So
my wife was making.
I appreciate it very much.
My wife was making fun of me last weekend. I come home and the dryer's not working. And so I'm in the basement and I got this whole thing torn all apart. I'm like, oh, the fuses, and I need a temperature sensor. And I'm like in my underwear, okay? And Jill's like, if the world could see you right now.
they would never take you seriously again.
Absolutely love that. It actually makes you. It actually makes you love you more. To be honest, so yeah, I love it.
And then I turned around and go, I'm not getting paid for this either.
Nor for your commentary, right? Yeah. But all right, going back to your point,
pricing power. Well, you break out everything for the most part, not everything, but nearly everything out there. What's happened in the front half of this year has been driven the let's say the margin improvements, the revenues, and the earnings, of course, has been due to pricing. And when you start listening to all of the companies, we're done. Pricing's over. I mean, we're almost done. I'm just calling it here that we're at the tail end of pricing. We might have a little bit of pricing comps left, but when I look across the board from General Mills to General Motors, all of them are saying, like, for instance, General Mills had about 10% of pricing, and they reported about, let's say, about 5% revenue growth, which means that their unit growth was -5. How do you have pricing going forward when your unit growth is negative? You don't. I'm just going to clue you in. You don't. And I'm hearing that across the board, and I'm seeing it where we're having unit growth that nowhere matches the pricing. You've got 10% pricing, and then you report 2% growth or something to that effect. And so the pricing is negative, yet the models all have pricing moving forward in it for about 5% next year. So the probability of these people, all these companies, being able to pull off pricing moving forward is like zero without a complete decay in demand. And that's what we're seeing, a decay in demand. So what I'm looking for is for pricing to drop. And you saw Ford, GM, Best Buy called it in the spring, said they're going back to 2019 discounting. And that, I think that might have been in May when they said that. So they were early to call that out. And just today, or maybe it was yesterday, Stellantis reported. That's an automaker. It's Fiat Chrysler. And they went on to say, everything's good. Our profits per car are awesome. It was awesome. And they're not discounting as much as they used to be, but it's growing. The slope is going the right way. And then they come out and they say, well, if you're worried about our margins and pricing going forward, don't worry about it, because we're going to really hammer our suppliers. And we're going to lay off a whole bunch of people. Does that sound like they have pricing power when they're doing that? And they're prefacing everything that, don't worry, we're going to really hammer away on margins. That's just screaming. We don't have pricing power. Prices are coming down. So feel comfort in this, that we're going to really squeeze our suppliers and our labor force. And that's what I keep hearing in almost all of the reports that are coming out. It's really fascinating. So I think we're about done with the pricing power. When it turns negative, companies are going to vomit all over themselves.
Yeah, I mean, I think
on the earnings line.
I mean, Mike, I think a lot of us have seen it even just in our utility bills, right? So I was joking with a good friend of mine, Thousand Air FX, Chris Moyer out of the UK, and he, we were joking today about how the gas companies, they took up price real fast when natty gas went from $3 to call it $9, right? So they took up pricing real fast, but they've been real slow in terms of bringing it down. And in fact, it's basically stuck at $4.5, $5, even though it's trading at $2.60, right? So it's the margin, and again, like, they can only get away with that.
So you would say,
yeah, I mean, like,
you would ask yourself,
but they can only get away with that for like so long, right? Because all this stuff,
Well, how long? How long? I'm going to tell you how long.
All right.
I'll tell you exactly.
I'm going to guess 9 months.
No.
Longer or short?
No, there'll be an event that happens. There'll be an event that happens that you watch. for when pricing ends, because pricing is only okay because it's not like people's incomes are in line with the pricing. It's not. That's why the unit growth is negative. So what they're having to do is scale back on the units that they're buying. And what kills it, and killed it in 07, 08, was when the credit card companies slowed the extension of credit. And that just happened to Cap One and Discover. And you're going to see it in auto loans. I mean, definitely you see it in auto loans because we have we're at peak repossessions right now.
Yeah.
So as soon as they slow credit because they don't like what they're seeing, that's when it happens. And we've seen this, Discover and Cap One have expanded credit this past year by 20%. This is some massive build of their credit exposure. And it's to the lower end. And they're both cutting, slowing the credit growth because they don't have good creditors. And that's it. So that's what I expect. And that's what we just saw. And it just happened. And we don't, nobody knows it yet because management hasn't started talking about it yet. But that's the first sign. It's the slowing of credit. Now, we've already seen the slowing of credit at the corporate level along all the mid-tier banks across the Midwest. And a lot of that because of the CRE bomb, that's commercial real estate bomb that's ongoing right now. But the consumer credit slowing, this is going to be an immediate problem.
Yeah, Mike, Josh Steiner, who you know well, is our financial sector head. For those that don't know, he made that comment today on the call. Actually, how I think it's on Amex. I'm forgetting which company he was referencing. To be perfectly frank with you, but sorry, it's just a little bit of a late Wednesday brain fart. But long story short, the commentary has been similar to what you were saying in terms of they're not recognizing it on the earnings call. But if you go back to 07, that summer of 07, or even summer of 08, I believe he said 07, right? It was
07 and 08.
Yeah, 7 and 08.
They slowed the credit,
but it didn't really. They really didn't pivot their commentary until 6 to 9 months later, when you were basically in the thick of it, and it was pretty clear that basically the consumer was having an issue, right? So
we're going to see that. We're going to see that on the low end, and we've already seen it on the low end. Okay, meaning that even though they're increasing their credit by 20% and getting new credit cards and doing the musical shares, paying off one credit card with the other and so forth, that is. The indications are to me that is coming to a halt now, and we're going to run into a problem, especially on the low end. And it always starts on the low end. Funniest thing, though, if you look at the high end, Louis Vuitton, Estee Lauder, or whatever, they're commenting that many of the aspirational buyers, meaning the guys that went out and got a $6,000 watch and such, they're gone now. And they're running into a problem. So the newbies that came in with fresh checks from the government are now gone, and now we're suffering through those comps right now in Louis Vuitton. I'm bearish Louis Vuitton, and we're getting it on. We will get it on the lower end too. So, and the signs are all there for it. So it's a little bit of tomorrow's news today, but this is what I'm seeing, which will affect us in the very short term. And the companies don't see it yet, because remember, most companies only have 3 weeks of visibility, even though they guide for the whole year. So, especially consumer companies, they have very short horizons in what they can actually see. So, but I think that in the summer they will see it, and they'll find it inexplicable, and then that'll be it.
Great commentary. And again, Mike, we were on the call this morning. Jeremy McLean had very similar commentary on Louis Vuitton, and Keith was right on top of it in terms of the
that buyer is going away, right? And it's a big deal. It's a big deal. But we got a question out of Jonathan here. I think it was Jonathan.
Sure.
Yeah. So, Jonathan, the floor is yours.
Hi, Robert McGordy here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
Hey, Mike, first of all, thanks so much. I mean, I've learned so much from you. Last time I think you were on, you called the TGA, sort of issue that you kept saying things are going much higher. So that was incredibly helpful.
I was wrong. So, I was right about the TGA and how they were going to go higher, but I was wrong on the other side of it, where they'd have to backfill this because Janet has decided to fund that and the government on very short-term paper. And she got the call from the White House to do whatever it takes to jack this market up. And that's what she's doing. So, go on.
Well, I didn't hear that one. I only heard the first one when you said, you got to be really careful shorting because it's going much higher. That was before they actually started branding the TGA fully.
That's right. That's right. Because it's a synthetic QE. And here she's doing everything that she can to keep asset prices up. Now, she has limited things which she can do on her end, but because of she's funding the government on the very short term right now, it actually acts like an Operation Twist, where she's not putting enough paper on the long end of the yield curve, and that will artificially suppress the yields.
Right.
So, now, for how long she can do it for, I don't know. But knowing this White House, they will fund the entire government on 30-day paper right up to the election. They'll do whatever it takes. They just don't care about the consequences. They don't think about it. They really just don't care. So it's really fascinating what's going on in the Treasury market right now. And it's enjoyable for me because I've never seen it before. I've never seen this kind of activity that is setting us up for a horrific reckoning that will be extremely painful in the name of an election that's 18 months away. So I'm sorry, go on. What's your question? I just got really diverted.
No, it's great stuff. And my question is really, I kind of was thinking the same thing. And again, I'm a novice compared to you, but I was sort of seeing some of those same things. And I noticed you tweeted the other day about, buying some QQQ puts in size. And I just want your thoughts as to whether or not that's a position for you that's more of a hedge position, or is this a position where you're actually taking or trying to make a legitimate call as to direction?
No, it was a trade. It was a trade because Netflix and what was the other company it was reporting? Tesla. Netflix and Tesla were reporting they're like apically peaky stocks. They are the market, and the puts that I could buy were so cheap that I bought them, and I made like, I don't know, 2.5 times my money, something like that, and I traded out of them, and not perfectly, by the way. I made money on it and I traded out of it. So I don't have like an incredibly bearish view yet on the market, and it's really just a matter of time. And I'd suggest to you, I think the best trade, I've been thinking about how to make it troglodyte simple.
Right.
Troglodyte. Every company that has pricing power, long. Every company that goes from positive pricing power to negative pricing power, short. That's it. So I look at the auto companies, they all have just gone negative pricing power. And so that's like the beginning of my thesis, in that I want to be short companies with negative pricing power. That's really the key. And so that's what I'm looking for, and that's what I'm scouring for. And that's actually what I'm going to be calling all the analysts at Hedgeye on, hopefully starting tomorrow. All right, let's go through the list. How many companies had positive pricing power that's going to go to negative pricing power? And that's because I think that's going to be the trade, that the vanilla benchmarkers are going to run from all these companies that turn to negative pricing power, because they know what's going to happen to the model. The model's going to implode. Now, the good news for like a Microsoft, a Google, and some of the other big guys is that they're kind of running monopolies, all right? And so they're not going to suffer from the negative pricing power as much. And that might be one of the reasons why these stocks are up so much. They won't lose the positive pricing, meaning that it won't turn negative until the very end. It'll turn negative when we're in a really nasty recession. But all the others, like the auto companies, materials companies, things like that had pricing power. I mean, look at Whirlpool. Whirlpool's another one. Yes. Anyway, Whirlpool is another one that is turning into negative pricing power. And you watch, look at OMC. That's a media company that sells old world, Mad Men ad space. All right. It went straight up to a 2-year high into the queue, and they reported U.S. sales plus 2.4%. And I'm remembering off the top of my head, so I beg your forgiveness if I'm wrong, but that's a number that I recall, where they had 10% pricing power, and it was at least 10%, yet they only reported a 2.4% increase. So that screams to me that pricing power is going to crater for them. Stock drops from a 2-year high, kind of in a straight line, down about 14%. And there's a tremendous amount of downside here because this is just the beginning. So that's my 2 cents on how to pick stocks in this environment.
So this in terms of your portfolio construction, Mike, if you're going kind of long short right now, just give it of like I mean, it's hard for some of us to go stock by stock. At least for me it is. So I had this sector ETFs, but just more like kind of, could you just give a sense of what you're running long short right now percentage wise, and maybe where you'd be looking sector wise, long short?
Okay. So if I had to look out longer term, like between here and the end of the year, I need to be long. So just due to the process of elimination, because I think that the staples are going to have negative pricing power. I think a lot of the industrials are going to end up having negative pricing power. And so you kind of start throwing things out, and you're kind of left with healthcare as a long. And I'm not trying to toot my own book here. I'm not talking my own book. You can express it in any way you want. You don't have to buy my fund.
No, we're seeing the same thing on the healthcare side, Mike.
Oh, okay. And that's only because like their pricing is going to remain stable. They won't suffer from the economic down cycle of negative pricing. There's going to be very few areas that aren't.
And sorry, again, this is on the healthcare side, Mike. Just kind of think about where we've come from a demand standpoint. There's been a lot of demand that's been suppressed, right? Just from folks not wanting to go to the doctor, or just not being in that routine of a doctor or surgeries that were postponed, like kind of post-COVID. That they are still kind of enjoying. I'm saying enjoying in air quotes here in terms of the kind of the COVID lag, right? And so all of a sudden, they do, 2 years post when they really could have gone back to the doctor. They finally are, and they realize, oh shit, I need an extra test, right? And so, and that test might lead to something else, surgery or whatever. So it's like, it's this kind of like, this is prolonged cycle, and it's a prolonged cycle where you've got, you've got unemployment at sort of lows, right? So a lot of the U.S. population is covered via healthcare, and therefore that provides you with sort of air cover from an individual standpoint to go forward with a procedure. So that's kind of, again, just to give you sort of a little bit additional kind of background or sort of the quasi narrative, which we don't love to do narratives on the Notebook Review, Mikey, as you know, but that is kind of
it's not a narrative,
but it's just not a narrative. It's not real. It is not narrative.
Real
data. The data is the reality of the situation.
It's real data.
It's real data. Reality of the situation. So
we have a large catch up that's underway right now, but also what happens is as people begin to fear for their jobs, and GM and Ford. Well, Ford didn't say it yet, but GM and Stellantis today basically said they're firing people. And what happens when people start getting worried about their jobs? They get that hip or knee done because they've been putting it off, and now they know that they might lose their job, and 18 months later lose their COBRA health care. They are incentivized to go and get medical procedures done. And we saw this in 2008. We saw a huge ramp in procedures 2007, 2008 as the job situation got worse. And it was surprising. People would think, they'll get fewer procedures because, they're not going to have health care. No, they actually rush in to get crap done that they've been putting off. So that's my experience. Yeah, and part of what I'll be doing with Hedgeye is going through that process of elimination and where I need to be, between now and let's say the end of the year, first quarter of next year. So I think healthcare is a good place to be. Oddly enough, what will happen if pricing goes negative, and I think it is we're going to see the dollar drop. And as the dollar drops, strangely and painfully, we may see energy and materials lift just because of that, in part because of that, and nobody owns it. So, counterintuitive to economic fundamentals, but very sound in the way of money flows. They generally start selling what they own and buying what they don't. And that's materials and oil and healthcare. So those are things I keep my eyes open for. And honestly, I generally hate materials and oil all the time, only because I'm just not good at making money in it. I just think at it.
Yes, just on the pricing power side, Mike. We're seeing like comms, especially kind of like Google and Meta. They have pricing power at the moment. They're coming out of the opposite, basically easier comps from a year ago where they didn't really have that pricing power. And so, yes, that's one area where obviously, and you're seeing that in their earnings releases currently. The other side of that would be, those that are lacking pricing power would be hotels, or in hotel REITs. So that would be one side that would be on the short side.
Especially the low-end hotels are going to get these credit cards getting, shut down or slowing for this group of people at the lower end. These lower end hotels are going to get smoked.
Yeah.
So in my view,
we would side with that as well. And then,
so I'm really excited about that. And then there's also one-offs, and I know our good friend here, John, isn't doing single names, but like take a look at a Netflix. A Netflix is a company that just ran into a once in a lifetime pricing power, essentially, where they're cutting off non-users or let's say cheating subs that are sharing passwords. And that effectively is a one-time pricing increase,
100%,
where they're clamping down. And so when you look at the comps and I know the argument is, well, they'll have pricing next year and therefore Netflix is going to be fine. I don't think so. I don't think so. I think that they're generating impossible comps for themselves. And then you look at like the beat that
so Mike,
it was like 2%. It was tiny.
Correct. And then you're going to run into a situation too, like the strikes that are happening, where content is being postponed, similar to what the COVID happened, right? So they were able to release content that they had in inventory able to take advantage of subscribers, new subscribers that were stuck at home and they needed, to stream something. But then it really hit them like basically 12 to 18 months post, basically mid 2021. And that was a big kind of issue for them, right? So,
well, I think the comps for next year are impossible because costs are going to go up and their comps on revenue can't be replicated.
Completely.
So I have no idea what
completely.
Meaning it's just going to stop
because
and the stock is still crazy up. Oh, and the founder stepped down. You kind of put that all together. You're like, oh, okay. Anyway, that's a single name. I'm bearishly positioned Netflix. I'm not terribly sized because it just came in a lot. I'd love to see it bounce. But in this market, frequently things just don't bounce. They go straight up and up and up and up, or they go down. And there's reasons for that. One of the biggest reasons is that there are not as many, there's too many retail and not enough, let's say, active manager vanilla investors versus the amount of algorithmic and passive flows. So, retail only knows FOMO, buy, and when it breaks, sell everything. And when they sell everything, it literally just doesn't stop. It's the same way how they just buy everything. It doesn't stop. So I think that things like Netflix, when it does turn, and if I recall correctly, it's at an unbelievably important spot on the chart right now today. I don't remember exactly what it is, but I remember taking a mental note of it as I was scanning through charts. I said, oh, this is a really big level. So someone will have to do the work and tell me that I'm wrong. Maybe I'm not. 50.
Yeah, so an interesting one sorry, just brief.
Well, it was the consensus pick on CNBC today, so probably is a great time.
Which one was?
Oh, Netflix?
Yeah.
Netflix, because it's the only, FANG name that's down. So you got to buy it.
Interesting fair trade, Mike. And again, I'm going to put this, I'm just going to.
Well, Mike, this is awesome. I just super grateful for you, man. You have really helped so much. I'm still in the learning process, but everything you do and say is just really helpful to me and all of us. So thanks for everything.
You're welcome. I'm not sure how much it's worth. I do my best. And remember, I'm still an amateur too. All right.
Yeah.
The only reason people think I'm not an amateur is because I've been doing it for so long. But the truth is, every single day I wake up, just remember me in my underwear with a wrench trying to fix a laundry machine in the basement. Okay. That's all
I can be able to get that image out of my head, to be honest. So, yeah. But Mike, I got an interesting pair trade here, and I'm just going to plant this in your brain. I don't need a response right now. Disney is in our bullpen, which basically, is neutral, Switzerland, whatever. But an interesting component from, especially from what we're talking about tonight in terms of pricing power, et cetera, long Disney, short Netflix. Now, again, that's not something that we have on Hedgeye. As I said, it's in our bullpen. But where, again, like non-consensus views, Netflix is quasi-loved. Disney is kind of hated at the moment. They're going through a whole restructuring process under.
Are they? Have they announced that yet?
I mean, I think it's like they haven't officially, but it's I mean, why?
No.
Why? Yeah, they haven't officially, but if you read the tea leaves, Mike, like you and I do, it's what's actually
why every single business is selling.
I mean, you actually know what's going on, right? So, but yeah, I mean, I think that's a really interesting one. Again, I can't trade either one because we cover them from a Hedgeye perspective, but that would be something that I would be looking at pretty closely.
Everyone's trying to find a bottom in Disney. And it's slowly just melting and melting and melting. And by the way, if you look at it on a PE, that thing is not cheap, not even close to cheap. And I'm not a value guy, but right now in this tape, expensive doesn't matter. So the which is very, very strange, by the way, because you'd think with the short end at 5% plus that expensive stocks would be penalized terribly, and they're not. So that whole argument about that dividend discount, so it's always versus the risk-free rate. Yeah, that's total nonsense, isn't it? Because take a look at this tape. Either that or this is like the biggest bull trap ever. So every single book is wrong, or this is a gigantic bull trap. Disney has to fire everybody. Pretty much every single person below the CEO needs to get let go. And they need new people to come in and start making new everything. A new vision, a new plan, a new movie portfolio, new writers. I mean, they basically have to take the politics out of Disney.
Yeah, I read
that's
last week.
Really hard to
You
do.
read last week that they're realizing that they basically they just lean so hard into Marvel. It's basically just not working anymore because people are just it's lost the appeal, right? In terms of, there used to be maybe 2 Marvel movies a year. Again, I don't know all the, fact check me on that. Maybe 4, whatever the number. But nowadays it's like there's a multiple Marvel series, right? So there's that content that's being released on Disney Plus. Then there's the stuff that goes to theaters, and there's probably at least 6 of those a year. They lean so heavily into that and the Star Wars brand, which they acquired, right? They acquired in the last sort of 10, 15 years.
Oh no, it's more recent than that.
Well, Marvel was 06 though, wasn't it?
Yeah, Star Wars was a purchase from Lucas. It might have been 6 years ago.
Yeah. But they've leaned so heavily into those titles that they kind of saturated the market, right? So anyway, yeah.
Actually, no, it's actually the product sucks. So it's not just that they've saturated.
From what perspective?
The product stinks. The Star Wars series, I mean, you literally just have, and this is my opinion only, but you have a very heavy woke agenda in these movies and these programs like Star Wars and so forth. So it becomes a sort of a political statement rather than a movie.
Rather than pure entertainment.
People don't like it. Yeah. They've basically taken the Star Wars dogma and completely dismantled it and turned it into a woke messaging theme. And people are turned off by it because this isn't what I want to see.
I love it.
And
this is why I love it, Taylor, because you can go everywhere from telling me why Pfizer sucks or is great to the woke messaging from Disney.
Well, it's 12 hours in front of the monitors, right?
I gotta get something out of it. I can talk about Disney as well, even though I don't trade the fucking thing. So it's
okay. Well, I do. So I watch it pretty closely, and it's really the problem is the middle, all that management below the CEO. Iger came back to fix this, and I think what he's realized is that it's not just the layer below him that's the problem. It's all the layers below that layer that's the problem, because you have brought on an entire management team that's deep with an agenda, with a view on how they want to change the world. And they forgot that their job is revenue and earnings. And it's very much like what happened to Bud Light, rather. They forgot. Who's your customer for Bud? This is your customer is, blue and gray collar people around the country, not a small, tiny fraction and they decided to market heavily to that rather than their core customer. And I think that's what's happened to Disney, is that they decided to make products that are, yes, much more inclusive, which is wonderful and important, but it can't be the focal point of your business because you will lose all your core customers. And that's what's happened. They're losing those customers and they're not watching it because they don't identify with it. And it's cost them, obviously. So that restructuring for Disney, I think, is going to be incredibly deep. And if it is not, they have a problem. And it's going to take a long time. Do you know how long it takes to get new scripts, new movies, new writers, new management to organize all of it?
Yeah,
Year.
That's kind of, yeah, exactly.
So I just want to jump in with Mike Taylor made a great point with Disney, but I've got a couple other points. I've actually been looking at Disney as a short, and it has nothing to do with what Mike Taylor brought up, which are completely valid points. ESPN is a major issue for Disney. Costs going up, contract renegotiations, as well as viewership dropping with, cord cutting, people dropping their Hulu subscription, people are subscribing to Netflix. They don't care about sports anymore. So that's a major pain point for Disney. Also,
and they can't find a buyer.
So yeah, 100%, right? And then on the other hand of it, the physical nature of Disney, the park attendance is way down at Disney World in Florida this year. And
why is that?
It's out of control. I mean, so they started raising.
That's because they try to take price. That's one of the things.
And so yeah, there's a discount cycle for Disney too. So I'm actually people are looking for a bottom of Disney. I don't see it. I've thought about shorting Disney, but and again, I didn't want to take away from Mike Taylor. Great points, but
I am very positioned.
I'm the only one that said maybe long Disney as a pair trade, but that's because you got Netflix on the other side of it. However, you guys have quasi convinced me that's a stupid pair trade. So, all I will end this.
I just think it'll take years to fix Disney.
So I know you don't have prices anymore, but you gotta watch. Gotta watch Bluey on Disney.
Oh my God, it's late. I didn't realize how late it is.
You gotta watch Bluey on Disney Plus, Mike Taylor. That show.
Only genius, Robert.
Genius is fucking one of the best cartoons ever made. It's like 8-minute episodes. It's out of Australia, and I'll tell you what, it is one of the best things that Disney ever bought the licenses to.
It's better for parents than for kids.
There's some nights like Mikey T that I will sit there and I'll crush like 3 episodes of Bluey just solo. Wife's not around, kids not around.
Bluey.
It's hilarious. Anyway, it is getting late. I've been on since 8:30.
Dude, I'm so
no.
I didn't know it was. Good. I wouldn't have come on.
Good. You and I should do something soon. But Trillion Cavill does have a quick cap. So his name's Pat. So Pat, I'm gonna pass the baton back to you. But then I am gonna wrap up because I got to get up at like 5 tomorrow. So Pat, the floor is yours, bud. You're on.
Yes. I was going to ask a couple questions to Keith, but he's gone. By the way, PCT is an excellent company. I just wanted to say thank you for that. That was an excellent find. Without your research, I would have never came across something of that nature. So I appreciate that. I did have a quick question, I guess, for Rob, if you're there. The Diamond Standard, I have a few coins. I was just curious, as an alternative asset class, is there anything of value you've identified or any research you're privy to that would lean towards adding that to one's portfolio?
What alternative asset class are you talking about?
Diamond what?
Yeah, sorry, I was just thinking, Mike, for PCT, it's a great research on that. And then I had a question on Diamond Standard. You guys had that interview coming up soon.
Oh, yeah.
Yeah, I was just, because I have a few coins myself. I think it's a brilliant product, but I was just curious as to your thoughts on it, or if you had any, or, adding it to your alternative asset class side of your portfolio. Thanks.
Yeah, I don't know, Mike. You probably don't know what this is, but
I do.
yeah, it's okay. But so I don't have any real additional commentary. It is. I enjoyed. I think we interviewed. Trying to blank on the gentleman's name, but we interviewed him maybe a year ago, and when he was kind of getting off the ground, it's a very interesting concept. It's certainly from an alternative perspective, yeah, it definitely is a way to diversify. But no, I don't really. So sorry, Pat, I really don't have much additional color there. I'll do some more due diligence, and give me a week, and I'll have some. Yeah.
Okay. Sorry, I did post something in the comment section there below on just some weekend research I've done on the Bitcoin sector as a whole, the mining companies in particular.
Oh, yeah. So block these.
If I may just, I guess, summarize real quick just for everybody. These the Bitcoin mining companies are heavily indebted. They actually hosted machine-backed collateralized loans for the miners themselves. So they actually posted a depreciating asset as the collateral for further fundraising and et cetera. And with the decreasing price of Bitcoin, as well as, so currently they're selling 120% of what they mine. So that means they're selling everything they mine today, as well as 20%, right? So they're selling everything today, as well as what they accumulated in the 0% interest rate environment. And so they're heavily indebted. You have higher debt servicing costs, obviously, in this environment, at a depreciating price. And on top of that, the biggest thing I guess I would like to highlight is that there's a halving coming up in, so you have massive insolvency risk across the entire sector. So the biggest thing that I'd like to highlight that is being discounted by the market is not only the Binance Department of Justice investigation. FTX is half the size of Binance, and it's 90% wash trading. The Tether depegging that could happen. This combined with everything else, you have the halving of Bitcoin in about April of 2024. So that means that these companies overnight will have outdated machines that are bringing in 50% less revenue on day one of that event. So if they're in trouble now, solvency-wise, April 2024, again, with the current yield curve and everything, rate cuts, illustrated, there's some serious trouble going to be happening in that sector from multiple angles. And I remember David Dorr had the interview when he was talking about Lockheed Martin's advanced technologies. I didn't know Lockheed Martin invented a anti-gravitational device for the crypto markets to defy gravity. But yeah, so gravity is definitely going to come into there as well. But I just thought I'd like to highlight that. And by the way, the entire sector of machinery is monopolized by one company in China called Bitmain. So the day that they do have that halving event, they're going to release a new twice as efficient miner. And how are these companies going to finance that upgrade when they're already inherently insolvent? Anyway, so just something to note that's going to matter. Thanks, guys.
Wow, that was very thoughtful. I never thought about that.
Yeah, that's awesome. My brain's going about. I got to go. I got to go look at the block ETF and go look at some of those miners.
Yeah, you're essentially going to have zero bids, and again with a proof of work coin like that. On a closing note, sorry. You have essentially a massive wave of selling pressure, and so the market cap and supply is increasing as liquidity globally. The consumer, the retail trader, etc. There's no cash left. I mean, there's no bids. And essentially the largest exchange in the world is under Department of Justice investigation. Sam Bankman-Fried is actually at the Bahamas consulate about 48 hours ago. So you can only imagine what he's telling investigators there. Probably going to lead to some type of extradition. Again, at least just from the work I've done over the past few weeks regarding that. So, that's just a nuke waiting to go off. Just thought I'd highlight that, right? So
I appreciate that.
I look at it like this when I look.
Yeah, so I wanted to ask Keith that, but I was too late. So yeah, anyway, but thanks, guys.
Just when I look at crypto and I think about it, I'm reminded of 2000 when every single coffee shop turned into a day trading firm, like literally on every other corner. And because at that time you couldn't trade on your phone and stuff like that. And everybody did it. And that was really, that was the top, because everyone was a genius and everyone was involved. And I look now, and I don't think that there is an Uber or Lyft driver that doesn't also trade crypto. That's what they do when they don't have a fare. So that just tells me a really maximum speculative saturation. So, and those are the things I want to stay away from going into a negative pricing power environment.
Yeah, no, agreed. All right, Mike.
And I can't stand crypto anyway. I mean, I can't. It's digital Pokemon cards. That's what everyone's trading, because it doesn't have any purpose. Like, what do you do ever? The only purpose is get rich quick because some idiot will buy it after I do. That's the entire thesis. It doesn't change the world, because you can make a fake currency digitally. I mean, why is it Bitcoin? Why isn't it 10,000 or 100,000 other coins? The whole name of the game is simply marketing to get your spending dollars to get your coin popular, so people will buy that coin from you with dollars, so you can get the dollars. And it's a negative NPV melt. That meaning that this thing costs money to have a service and an infrastructure and all that. So it's not like gold, where you just put it on the shelf and there it is. No, you actually need energy, power, some sort of infrastructure in order to actually have this thing work. So,
yeah.
And there's as many cryptos as you could possibly imagine, an infinite number. So all of it just bothers me.
I think you and I could have a spaces on that topic alone. Mike.
Yeah. Well, no, I don't want to have that, because too many lunatics will come on the line and just tell me I'm an idiot. And you know what? They're probably right. It's probably the future. So
I will with
guys.
That, no,
thank you so much.
Taylor, thanks for jumping on. I appreciate it, bud. And we'll
pleasure.
No, absolutely. So thanks everybody for listening in. This was the Weekly Notebook Review. Happens on Wednesdays. And again, if you did catch all of tonight's episode, session, which started at 8:30 Eastern, you'll be able to get the replay here on Spaces or Twitter, as well as throughout the Hedgeye podcast channel. So with that, we'll see you guys next week. Mike Taylor, appreciate your time, buddy. And thank you for all the speakers and great commentary. Questions are asked tonight. So thanks for that. This was definitely, as Brian mentioned, was definitely a bit more of an old school Weekly Notebook Review, and I loved every minute. So with that, I bid you all adieu, and we'll see you next week. Same time, same place. Cheers.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.